Hey guys!
Hello.
What are you doing?
We are review of a lesson for the final exam.
Oh great, I don't understand about risk and return. Can someone explain to me?
Sure, we can explain it to you, or you can use this AI that our professor has been created to help us guide about the lesson that you're not clear about.
Oh, sounds good.
Okay, so now let's start together.
So first, we need to understand about the risk and return first. So let's start with the first one is risk. Risk is the chance that the actual outcome of an investment will differ from the expected outcome, typically the possibility of losing some or all of the original investment. In simple terms, risk is the uncertainty of how much money you will actually make or lose. For return, is the gain or loss an investor make on an investment over a certain period. It usually expressed as a percentage of the original amount invested, or we can say is how much money you earn or lost from your investment. Example, investing in stock can give you higher return than a saving account, but you might lose money. The saving account is safe but give you the low return. The key idea is you cannot get high return without taking on some level of risk. Investing in Cambodia, stock market like CSX, such as PPWSA, Phnom Penh Water Supply Authority, offer a higher return potential but come with price fluctuation, or you can say risk. Investing in an Akleda Bank saving account give a low return. It's around 2% to 3% per year, but it's very safe. And the last is the key principle is higher return usually come with higher risk.
Here are some common types of risk investors face. Market risk. The risk of investment losing value due to market fluctuation. If the Cambodian stock market index dropped due to regional political instability, investor holding share in Cambodian listed company could see a loss in value. Inflation risk. The risk that inflation will erode the purchasing power of your return. If inflation in Cambodia rises rapidly, the real return on fixed income investment like government bond becomes negative. Currency risk. The risk that change in currency exchange rate will negatively affect investment return. If an investor from the US invests in Cambodia and the Cambodian rate depreciates sharply against the US dollar, the risk to return in the last term could be reduced. Liquidity risk. The risk that an investor cannot buy or sell investment equity without affecting the price. Some Cambodian real estate or land investment may take a long time to sell, especially in rural areas, making it hard for investors to quickly convert them into cash. Credit risk. The risk that a borrower will default on a loan or bond. If a Cambodian microfinance institution issue bond and later struggle to pay due to high borrower default rates, investor in those bonds may lose money. Political risk. The risk of due to political instability or government decision. If the Cambodian government change foreign investment law or nationalize tenants, it could negatively affect foreign direct investment in sector, the real estate or agriculture.
So now I'll be talking about measuring risk and return. We need to know what is standard deviation. So it measures volatility, how much the return varies from the average. So the higher deviation is equal to the higher risk. Therefore, it is the measures of how much a stock moves compared to the market. And these are the conditions. So if the beta equal 1, it means that the move like the market. But if the beta is greater than 1, more volatile than the market. And if the beta is smaller than 1, it's less volatile. In addition, the expected return, the average return that you expect from an investment over time. Here is the chart that I have taken from the Cambodia Stock Exchange website to show you. Moreover, return is how much profit you make. For example, if you buy PPWSA stock at 2,000 real and sell it at 2,000 and 2,000 real, that's a 10% return. It means that you earn a profit of 200 real as a return.
Want to reduce your investment risk in Cambodia? One simple way is through diversification. Imagine putting all of your money in just one company like PPWSA. If the stock drops, you lose a lot. But if you spread your money across different assets like stocks, real estate, and bonds, you reduce the chance of losing everything. Here is a simple example. In Cambodia, you can choose PPWSA stocks, Lands in Siem Reap, or Hattha Bank bond. If land price falls in Siem Reap, your stock or bond might still do well, so your total investment doesn't suffer too much. Diversification doesn't remove all risk, but it gives you a stronger, safer portfolio, especially in a growing economy like Cambodia's.
Let's quick understand the concept of risk versus return in stock and bond. As we know already that PPWSA stock on Cambodia Security Exchange. If you buy PPWSA stock, you actually buying part of the company, so your return depends on the company's performance. If the company underperforms, stock price may fall, that is your risk. But if the company grow and earn more profit, the stock price may go up and you make money from the return. Let's say PPWSA issue bond instead. That means they are borrowing money from investors like you. It means you don't own a part of the company, but you receive regular interest payments. So it's safer because return are fixed and predictable, but your earning potential is usually lower than the stock.
Alright, I got it now. I hope you guys understand about risk and return of